Taxpayers, if you want to save a large amount of money in taxes this year, then you're going to need to know the best tax planning strategies. So in today's video, I'm going to break down the 5 best tax planning strategies for 2024. But make sure that you stay all the way until the end of this video, because every single one of these strategies can help you tremendously reduce your tax bill. Without further ado, let's dive in. Strategy number 1, maxing out your 401k. Tens of millions of Americans have 401ks, and one of the main reasons why so many people like these retirement accounts is because they have amazing tax benefits. For example, with traditional 401ks, you can make contributions with pre-tax dollars. Then the account grows tax deferred. You only have to pay taxes when you withdraw later in retirement. With Roth 401ks, you make contributions with after-tax dollars. Then your account can grow completely tax-free. When you're ready to start taking distributions from this account, you will not owe any taxes. Whether you get a traditional 401k or a Roth 401k, you can experience tax benefits. In order to optimize your tax benefits, then you should strive to max out your 401k every year. This is especially important if your employer offers a match. The larger that your 401k is, the more tax benefits that you get. In 2024, you are allowed to contribute up to $23,000 as an employee. So, if you're a W-2 earner and if you have a 401k, then try to get as close to this as possible. Let's jump to strategy number 2, optimizing your home office deduction. It is estimated that 58% of the American workforce now works from home, at least some sort of the time. And if you own a business and your home is your primary place of business, then you can potentially qualify for the home office deduction. However, as a reminder, to qualify for this deduction, you will need to use an area of your home exclusively and regularly for business. Many people are aware of the home office deduction. However, a lot of people do not understand exactly how powerful this deduction really is. Part of the reason why this is the case is because the IRS gives you 2 ways to take the home office deduction: the simplified method and the actual expense method, which is also known as the regular method. Of the 2 options, the simplified method is the easier by far. And with the simplified method, you get to deduct $5 per square foot up to a maximum of 300 square feet. This gives you a maximum deduction of only $1,500. Although it is significantly easier to calculate your home office deduction with the simplified method, if you use this option, then you will most likely end up with a smaller deduction. That is why I almost always recommend that my clients use the regular method. With the regular method, you deduct your home office expenses as a percentage of the total expense of your home. If your home office represents 10% of the square footage of your home, then you can deduct 10% of the total expenses for the home. This can include your rent, your mortgage interest, your utilities, repairs, maintenance, and yes, depreciation. When you use the regular method and when you use it correctly, you can end up getting a significantly larger home office deduction instead of having a $1,500 home office deduction like you would with the simplified method. You might be able to get anywhere between $5,000 to $10,000 for your home office deduction, or potentially even larger. If you qualify for the home office deduction, consider using the regular method to optimize this deduction. Strategy number 3 is invest in short-term rental real estate. The simple truth is that many of the best tax breaks in the entire tax code are reserved for real estate investors. So if you want to save as much money as possible in this year's taxes, then consider investing in real estate. And if you're going to invest in real estate, consider investing in short-term real estate. The reason why short-term real estate like Airbnbs and VRBOs can be so beneficial from a tax perspective is because there is a loophole for this type of real estate that allows short-term real estate investors to use real estate losses to offset their 1099 or their W-2 income. This means that if you're a doctor, a lawyer, or an entrepreneur, and if you invest in short-term real estate, you will be able to use losses from your real estate investments to offset income that you earn from your main job or business. Using the short-term rental loophole is such an effective tax strategy that many people who use it are able to save 50 to even 80% in taxes, and some can even become completely tax-free. The simplest way to invest in short-term real estate is to buy rental properties and set them up on Airbnb or VRBO. Now, in order to use the short-term rental rule correctly, make sure that the average stay of your rental property is 7 days or less. Regular viewers of my channel know that this is my favorite tax strategy, and I talk about it at length in many other videos. So check those videos out if you would like to learn more. Let's jump to strategy number 4. Take advantage of the 529 plans. If you are not familiar with 529 plans, they are tax-advantaged investment accounts that are specifically built to help you fund education expenses. At the start of 2024, a massive rule change went into effect for these accounts that has made them significantly more attractive from a tax planning perspective. The rule change allows you to roll over unused funds inside of your 529 plan into a Roth IRA without any tax consequence or penalty. Before this rule went into effect, there was a 10% penalty if you wanted to do this, and you would also have to pay income taxes on any money you withdrew from your 529 plan that you did not spend directly on qualified education expenses. However, because the rules have officially now changed for 529 plans, and because you can now easily roll over any unused funds in your 529 plan directly into your Roth IRA, it means that you can now use a 529 plan to save for education expenses and your retirement. This gives 529 plans a lot more value, and it means that you should strongly consider having one if you're saving for your own education cost or for a beneficiary. 529 plans are commonly used by parents or grandparents to fund education costs for their children or grandchildren. However, many people use them to fund their own education costs as well. Let's jump to strategy number 5. Consider moving states. This is a very straightforward and bold tax strategy. In fact, it is so bold that many people overlook it. But the bottom line is that certain states tax their citizens way less than others. And sometimes the best thing to do if you want to save money in taxes is to simply just move to a state that taxes you less. In recent years, a number of high-profile celebrities and billionaires have left high-tax states and moved to low-tax states. One of the most recent examples of this is Jeff Bezos. After living in Seattle, Washington for 30 years while building and running Amazon's empire, Jeff Bezos recently moved to Miami, Florida. This move came shortly after Washington State announced that it would be imposing a 7% tax on stock sales over $250,000 in value. Considering the fact that Bezos owns billions of dollars of Amazon stock, he simply decided to move to Florida to avoid having to fork over incredible amounts of money through this new tax when he sells some of his shares. It is estimated that he will save over $600 million in state taxes with this move. Other examples of high-profile and incredibly wealthy individuals leaving high-tax states in recent years includes Elon Musk and Joe Rogan, both leaving high-tax states like California to low-tax states like Texas. Rogan fled California in 2020 and Musk left in 2021, but both of them brought their businesses with them. And now, Tesla's corporate headquarters is now located in Austin, Texas. It used to be located in Palo Alto, California. So, if you live in a high-tax state like California, New York, Hawaii, New Jersey, Minnesota, then remember, you can always just move to another low-tax state if you're tired of the high taxes, just like Bezos, Rogan, and Musk. But when it comes to tax planning, location definitely matters. And the bottom line for tax planning strategies in 2024 is that all of the ones that I mentioned in this video can be extremely beneficial. So even if you can just implement one or two of them, then it can make a huge difference on your tax returns. If you have any questions about any of these tax planning strategies, then feel free to schedule a complimentary consultation with my team by clicking on the link below in the description. Also, make sure to check out my new Tax Strategy Accelerator community. Guys, I have jam-packed this community with incredibly valuable tax resources that my team and I have curated specifically for my followers. There are courses, ebooks, and other resources that I promise you do not want to miss out on your journey to tax-free wealth. The Tax Alchemy advisors and myself regularly answer questions, and we drop tax gems in this community every single day. The best part is that you can get started in the community 100% for free. So make sure to check that out as well. The link is in the description below. That's all I got for today's video. Thank you so much for watching, and I look forward to seeing you on the next one. Cheers.